Good morning, class. This is your instructor. Today I'm going to be talking about financial statement analysis, which is chapter 14. The book is Financial and Managerial Accounting by William Beckner and Marcello, and that edition is 18. So I'm going to be talking first of all about the reason why we need this analysis. So what is financial statement analysis in the first place? Analyzing something is basically partaking in the study of the key financial figures that the organization has claimed that are the real thing. So for instance, they could be the basis of the performance. So they are the key performance indicators. Primarily, these are important for the creditors. The debtors usually have they have to the creditors, they have to give this picture that they are in a position to pay back their debt. Therefore, any investors, so all there are two kind of financing sources, main financing sources. So first would be the company going to the banks. Then the second one would be the companies issuing shares, and they have to be answerable to the stockholders. So why we need this financial position is to gather or surmise about the company's performance, ability to pay back the loan or the debt that they have taken, and ability of the enterprise to earn cash through its operating activities in the foreseeable future. So it's going to be a going concern, right? So I have to now give you the overall picture about the company's percentage changes for the dollar values, as well as any kind of the ratios, any kind of the earnings, assets, and working capital quality that can be reflected from the balance sheet position of the company or the firm. Now, when we talk about the company or the entity, the enterprise has to be a publicly listed company. That's why we are even talking about the balance sheet or the income statement. We're not talking about those companies which cannot be, the financial statements of which cannot be audited. So we have the various ratios. We have the trends. Now, trend basically is something which is sort of like just like you can say the flow of something, or it's a behavior or behavioral pattern going from one year to the next. So it's the preceding year. You can compare your performance for the for as long the company has been in operation, and usually we take 2 to 3 years back, and then we go onwards from there. So it is now in the first learning objective that we have the use of dollar and percentage changes. Then we have trend percentages. Okay, so now when we talk about dollar, it means in terms of dollar when you're going to be measuring the income or the sales or the cost of sales of the company from the past year. So the base year was going to be the preceding year in this case. But for trend percentage, we could have one fixed base year. So I say if this is the year 2020, okay, but I'm not going to talk about the balance sheet for 2020. I'm going to talk about the balance sheet or income statement for 2019 and 18, because the balance sheet for 2020 would be available in 2021. So I say that let's suppose in the last 3 years, beginning from 2019, 18, and 17, I'm going to be comparing my performance, keeping base year as 2016. So now then 16 could be my fixed base for measuring the trend. As a percentage, when we take, then that could be dividing it by that base year, which is fixed. However, for dollar and percentage change, you don't have to have a fixed base year. It could change or vary from the year to year, keeping just the preceding year as the base. Then you have the quality of earnings. So basically, you can have the working capital, which is current assets minus current liabilities, just the excess of, you can say, current assets over the liabilities that the company is bound to pay in short term. So we can also have earnings, which is the earnings per share as well. And there are different kinds of earnings. We can also have the asset turnover for assets. So assets, this figure of assets is very important even for debt ratios. So we have different ratios as well. Then we can have the nature and purpose of classification financial statement. So now you should always know that classification is having similar items. So now what is an item basically? A balance sheet could have current assets, could have current liabilities, so each available item could be the single component in that current asset. For instance, we can have cash equivalents, we could have marketable securities, we could have closing inventories. And then that is one single item for current assets, right? So then you can have different items clubbed together, and that would be the classification. And that is very different from consolidation, by the way, because we're also going to be studying the consolidation. The difference between consolidation and classification would lie where we talk about the parent company and the subsidiaries that are involved. So, for instance, we have a large company. So I'm going to be taking you forward from here. Then let's just split this lecture in two. So I'm going to be in the next lecture discussing about the overall picture of the trend analysis, the financial statement analysis, keeping the whole view of the financial position of the company. Let's just go towards, at the moment, with Johnson & Johnson, which is a very big company, and also PepsiCo. So all they have different sub-brands. So talking about Johnson & Johnson here, you can see that they have billions of dollars worth of sales provided to the customers. So it does not necessarily mean that they're performing really well. Okay, so you have to keep many things into consideration. You have to take things in perspective and into consideration, especially when it comes to the industrial performance. So there's not just one key thing that could highlight the performance of the company. It also has to do with the industrial preferences, industrial trends, industrial averages for that particular profit-making entity. So in this case, let's just say that they have $1.3 billion of assets, and they have virtually business in all around the world. However, if their business is financed, major part of the business is financed through loans, and the assets have major chunk financed from a loan activity of the companies, that means they don't have their own venture capital involved in this. So this would not be a pretty picture for the enterprise. You just cannot base your decisions on one figure, or one key figure in this case. So then this is the thing. This is the biggest. Is the financial performance. Is you can have disasters such as that of Enron just based on size of the company. So sizes don't just matter. They have to be compared with what is the source of funds then for the company, and where those funds are directed. Is it growing? Are they having some kind of an acquisition? And then operating activities and cash flows are very important. We've already done cash flows in the previous lectures. You can just go back and revert to them. Now, the important question that they are even asking is, so for instance, we have, let's just look at this, net income of 15,000 million, so it's just billion, representing a return of 11.6%. So how do you compare or calculate that return? It's just, as a percentage of, you could take total assets. That would give you as a base for total assets 11.6. But is that 11.6 good enough? Can you say that net income generated from having total base of assets as whichever that base is, just giving you the percentage of 11.6%? So would this be enough or sufficient? You can just calculate the total assets by dividing it by 11.6 anyway percent. So now the difficult question is that satisfactory performance? So why is it difficult? Because other companies could well be having more than 20% in this case. So you need to compare similar businesses within the paradigms of the same industrial practices, or having the same businesses within that industry, to calculate or to be able to assess whether this particular company is doing well or not. So we have measures that are to evaluate corporate performance, and then there are various bodies, government bodies such as Security Exchange Commission, and we have FASB, which is the Financial Accounting Standards Board. So FASB is basically for US and Canada, but we have IAS, which is the International Accounting Standards Board for UK, and EFRIC, which is the International Financial Reporting. We have a council that is preparing different standards to regulate the accounting profession in this case. Then we have other high quality reporting standards. So all this is just done to protect the investors' interest, because you don't want to really invest in a company or to buy shares of the company which you think is not going to be a going concern in the future. So now let's just look at PepsiCo, for instance. Okay, so before that also they have given you the differences of what is classified and what is comparative financial statement. So like I said, when we take the example of PepsiCo, so the main parent company could be PepsiCo, that could be incorporated in, let's say, the United States, right? But it could have different subsidiaries. Subsidiary is something akin to, it's not a branch exactly, but it is having its own independent existence, and it could be answerable for its profits to the parent company if its shares are owned by the parent company more than 50% or 50%. So for instance, now they've given you an example of Quaker Foods, Frito-Lay, and then they have Tropicana. These products are given by the subsidiaries or parent organization could be holding some interests, controlling interests in the subsidiaries. And so the branch is basically the branch does not have any independence whatsoever. They are answerable for each and everything, for their profits, for the management decisions. All managerial decisions are aligned with the parent organization in this case. So now comparative financial statement and consolidated, the difference is that when you consolidate, it means that you are going to accumulate. So what do you accumulate? You have various sub-financial statements, I would say, of each and every subsidiary. The one subsidiary could be in Dubai, one could be in Pakistan, the other could be in Bangladesh. So all these could have some kind of reporting procedures to the parent company, and then they would align and then send their key figures to parent organization, and then parent organization would be making one consolidated accumulated profit figure or balance sheet figure. So when I say profit, it would mean that they would have the net sales, which would be in this case segmented. So this segmentation would mean that this is not just from wholesale, you're going to be splitting it into segmented revenue. So segmented would mean that there are different streams for that sale to acquire a lump sum figure, and that will be split. So when you consolidate, then that means that this financial position will be consolidated into one after the split has been unified. And then when you compare the financial statement, it would be from the preceding year, what was the performance this year. So these are the two key differences between comparative and consolidated, right? So these are not very known as operating results, and then there are subsidiaries for single business organization. Okay, now for example, we have auditors such as KPMG LLP, which is a limited liability partnership, and it's an international public accounting firm. They're just giving you an example that they have audited this, and Home Deco is basically for housemaking. This just helps or aids the people, the population to build houses. And they have given you at the end of the text, so basically we could be discussing Appendix A in the next lecture, or you could just look at it and you will be doing the questions. This is an accounting firm which is looking at the financial figures for Pepsi company and its subsidiaries. So Aquafina is also, they're just telling you that the subsidiaries are perhaps involved in making these different products for one company, which is PepsiCo. Now let's just move on to the next topic. So when we talk about analysis, in this case, so now the first thing is the tool of analysis, comparative income statement. Sometimes it becomes easier for you to judge the performance if you look at key figures. So if you can say this is $100 change. So when you talk about a dollar change, it would mean that from year to year, the value of the change either could be constant for the amount which is changing in terms of dollars or expressed in terms of dollars. That could be, so if you see the difference from 400 to 500 is just $100, and from 500 to 600 is again $100. So now even if the value is the same in terms of change in dollar value, but this does not necessarily reflect the percentage change to be the same. Okay, so let me just rephrase that. I could say that the dollar value is constant. So for instance, from 400 to 500 the dollar value is same, and from 500 to 600 the dollar value is again $100, which is same. But if you see this $100, the difference is basically, you can just have the difference divided by the original. In this case, could be 600 minus 500 over 500. So this could be 100 by 500 or 1 by 5. And 1 by 5 is 20%. So I would say that there's a 20% shift upwards in net sales from the previous year. But when you talk about from 2016 to 17, now you can see that the change first in the numerator is the same. So we could have 500 minus 400 is $100, but divided by the denominator now changes because now you have the base as 400. So $100 by 400 is actually 1 by 4. Now you know this 1 by 4 is actually 25%, right? So I would say that this is 25% and this is 20%. So the rise here, notice, or the raise is 25%. So you see that the net sales have actually increased by 25% in 2017, but they have increased at a decreasing rate, or you can say that they have increased by 20% in 2018, even though the dollar value is the same. And this could be pretty helpful to determine, and always remember that the latest figures are always towards the left-hand side of the overall comparative income statement position, where in the column wise is bifurcation per year, and then on the left side you have the recent year. And as you can see, they have explained this part that you can just simply compare that the sales even though increasing, and then the cost of sales is also going up. But then the main thing is that okay, so you can also see that these figures are in thousands of dollars, so these are reported as 600,000. So if any statement above say that it's in, or it could be, or just presented as 0.000, so it could mean that this or comma 000, depending on the country. So this basically means that you have to add 3 further zeros to it, so this could be 600,000, 500,000, 400,000. And then let's just, they have just explained the same thing to you. So I have explained to you what is a dollar and percentage change. So percentage change, the dollar change is 100 in this case, percentage change could be what I've just told you is 25% and 20% in this case. Okay, they have just recreated all this fact. You can just see dollar and percentage changes. So now, why they say that the percentage is misleading in this case? Okay, so before that, let's just go up and see what they're trying to say here. Assume that a company's sales increase by 3%. Okay, so now in this case, you're actually trying to evaluate whether the change that occurred is favorable, is actually, or its intrinsic value is favorable. So now you can see that the sales increased by 3%. Okay, so while the general price level rises by 4%. So that means that you can have the inflation factor, more than covering the increase which took place in the sales. So overall, you can say that the company is, even though it might register the sales increase, however, the inflation value will tell you that this sale is actually not more than what it was in the previous year. So actually the sales figure is just superficial, or the sales have actually declined in this case. So the company may have sold fewer goods than in the preceding year in this case. And then also for quarterly sales, for comparison purposes, even when we talk about short term for 6 months or for 3 months for quarter or semi-annual, it's very important to note that for the preceding year, you're not going to be comparing a different time period than that which is being compared. That means that, for instance, any time of the year that you choose, it could be from January to March, or it could be from April to June. It means that this time period has to be matched with the same time period in the preceding year, so that there would not be any anomaly reported in especially cyclical businesses, or because their turnover is actually very different per season. So there are seasonal highs and lows for sales reported for business activity. And then, as you can see, there are fluctuations which could be, let's say, if a company is selling sweaters, so that sale naturally would be higher, or if they're selling shawls, that could be higher for winter time, and it could not be as much, or it couldn't be registering that much influx of customers in the middle part of the year. So from, let's say, April to August, it could be very slow. People could occasionally be visiting, but that would not be sufficient enough to even compare closely with the sales that are in December. So businesses usually switch to a different form of business when, especially the nature of their business is sensitive to seasonal or season sensitive in this case. Similarly, they say that there are certain percentages which could be misleading when the base is small. And this is a very important concept, because you can see that, for instance, in the first year, you had, and also that reminds me to tell you that you can only compare or have the comparison possible if in the preceding year there was some value of sales, if or some profit or anything that you're comparing. So if for instance, the sales were 0 or the profit was 0, then you won't be able to divide by 0. So then in that case, comparison would not be possible, because anything which is divided by 0 could give you an infinity. So you cannot have comparison possible when it comes to 0 or negative figures. That means that if you're running in losses, so if you are not earning profit, in this case, you can't divide by a negative figure, because you don't want to have comparison reported negative. And similarly, if your profit was the first year as a base year, could be any value. In this case, they say that company had net income of 100,000. So now I'm talking about why could be sales misleading. So it could be 100,000 in the first year, then in the second year it drops to 10,000. So you can often see that the media reports about a big jump in companies' performance or sales. And as for this key example, they say that profits have perhaps jumped by 100%, 200%, or even 800% or 1,000%. I mean, it's 1,000 times even more than the original sales. So you can't really get too impressed, too misled by this information. The reason being that you can have perhaps 0 value in the preceding year. So if you, let's suppose in the first year you had $100, in the second year you got $0, and the third year again you recovered and you got $100. So that means that now this could be 100 times more. And this 100 times is very misleading, because you actually earned nothing in the previous year. Now look at this example now. They say that a company had net income of 100,000 in the first year, and that in the second year the net income drops to 10,000. So now you can have So now you can just have $90,000 actually the change. There's a drop. Income drops to 10,000 would mean different from it dropped by 10,000. Okay, so now it just says it drops to 10,000. It would it would mean that now it was initially 100,000, now it has become $10,000, and there's a change, there's a drop by $90,000 in this case. But then in the third year, it recovered to again 100,000, same level which it was earning in the first year. So now you can see that again the net income has increased by 90,000. So yeah, so this is 90,000. So now if you can just simply, see from 10,000 to 90,000 would actually mean 90 minus, this is 100,000, okay. So third year this increased by 90,000. Again it's coming towards 100,000. So from 10,000 it is going to again $100,000. So now 100 minus 10 would give you 90,000 by, again the difference is the original value, which is 10,000. Now let me just rephrase that. When your income dropped to $10,000, and then again in the third year it became $100,000. So now the second value minus the original value is 10,000. So 100,000 minus 10,000 divided by 10,000. So in this case it would be 90,000 over 10,000, and that would give you 900% increase. So when you divide by 10,000 the 90,000, this will just give you 9. Okay? And this dollar symbol will be cancelled. So the ratio 9 into 100% would give you 900%. And this is a very misleading figure because apparently reporting actually recovered. But when the figures come to talk, then you can see that it's just 900%, which is a major chunk. It's a lot of values, exorbitant, and this is actually offsetting, as they say. This is exactly offsetting that 90%, which is the loss that the company faced or it incurred when the profits plunged, and the income was it just fell to 10,000 from 100,000. So this 90,000 at that time minus 90,000, and this positive 90,000. It just gets 90% decline in profit is just cancelled. Okay, so this 90,000 decline, and then again going up by 90,000, and then that is cancelled. Each other is offset. Now we're talking about credit percentages. As I told you that for credit percentage you need to have one fixed base. So in this, say that for example you can have 2013 is selected as the base year. So each and every sale figure for each and every year per item could be divided by that base year. So every item that you see here could be divided by that base year. So for sales in 2018 expressed as a percentage of 2013 as base year for sales could be 450,000 by 300,000 as expressed, and it could be many times more. So if I had calculator, let's just see how much does that become. So as you can see, this is so now we have 450,000 by 300,000. So now we can have 150% increase in sales. But you also, like I told you, look at the inflationary aspects, and that is not sufficient. So now, same is the case for this net income. So you just have to divide each and every express. As you can see, this is 150%. Like I just calculated this, you see the sales are 150%, 120, and so on. Then when you divide this base year by the base year, obviously it's going to give you 1 into 100% will be 100%. Similarly, we have component percentages. Now it is the relative size of each item. So this could be now the net sales by the total sales figures. So by relative, we talk about, this is also known as the common size income statement. This is another application, which is to understand each value or each component of the income statement as a percentage of the sales figure. Now there are different components. In this case, as you can see, this is net sales. Net sales are perhaps netted off from your credit sales. It depends upon whether the enterprise is following the core basis of accounting or the cash basis. And then we have or it could be also the total sales figure, gross sales minus the sales returns. So what is the sales return? Some students do get confused in this. Any kind of item returned, this is very common when it comes to selling milk. So or chocolates or perishable items where when the goods are reaching the expiry date and the retailers are unable to sell all those items. So they will just kind of send all those back to the company that placed those in, let's say, a general store or in a big store, grocery store, and a chemist shop, and a drugstore, etc. So that will mean that we have those returns subtracted from the actual sales figure. So you get the cross minus the returns, you can have net sales. Then for dollar value, again, when you get percentage, that means that everything expressed in terms of the net sales. 1 million by 1 million would give you 100%. 700,000 by 1 million would give you 70%. 50,000 by 1 million would give you 25%. And 50,000 by 1 million would give you just 5%. So each and everything divided by the main value, which is ours. As you can see, this is there is also vertical analysis and horizontal analysis. But we are at the moment just doing this. This is the vertical analysis and a common size income statement in this case, expressed in terms of sales. Now we have ratios, which is the next part. So what is a ratio? Anything which is expressed as as a fraction of something. So when we talk about financial ratios, the most common of them is current ratio. Then we have quick ratio. Then we have leverage or debt ratio as well. And we have different other ratios as well. But at the moment, I think we should be focused on 2 to 3 things at a time, and then revert to the next lecture to the previous concepts. Keeping those in mind, we can just go back towards other lectures that I'm going to be delivering in the near future. So as you can see, this standards. Okay, so there are 2 things that are to be remembered. First part is that you have to look at the industrial averages. Why ratios are important is because it helps to determine where the company could have enough liquidity that it dissolves, will be able to pay back its creditors and stockholders. And then it gives the performance and the activity and the operating activity of the company to be able to generate cash flows. The next thing is that whether it is able to, on its own, generate income or cash. So the first is the past performance being analyzed, where the company is headed to, looking at that's why I said when we revert to the previous concepts as a base for the next lectures, it means that you have to look at this main principle as a going concern principle of accounting, which says that the entity has, or the enterprise has to be a going concern. It has to operate in the near future or foreseeable future. What it means is that it should be able to, through the cash flow position, be able to generate cash. Now, when I talk about cash flows, I'm strictly talking about cash flows from operating activities, because from financing activities, it's just taking loan and then increasing your cash flows. And investing is something you're selling part of the business, you're disposing of assets, which is also a bad thing. So the performance is in terms of cash flow from operating activities, because that is what generates cash for the firm when it sells its inventories. And then you look at the next part is that, so there is a horizontal comparison within the same industry, and looking at the trend analysis, which is the past performance and the dollar change and the percent change. Then they talk about the weakness of the horizontal analysis, that horizontal analysis, and I said that there are two kinds of analysis. One is a vertical analysis, which is common size analysis, and there is a horizontal analysis, which is comparison with the past values. There's a weakness, because obviously you can't assess if the company was running in losses. So as you can see that the net income was 2% of sales last year and it's 3% this year, indicates improvement. But if there is evidence that based on industry standards net income should be 7%, therefore it is unfavorable. So that's why it's also important, as well that if it is running into losses, you can't really have that as a base. And then we have industry standards, amply discussed. Okay, just go through this. I want to look at the ratio just quickly. Go over this. So I have already discussed the nature and purpose of classification. We've already done this classification in previous classes, where we were talking about the principles of accounting, and we've done the balance sheet and and the composition of balance sheet. It has current assets and fixed assets. Then we have short-term liabilities and long-term liabilities. And then we have equity and retained earnings. Okay, what are current assets? Usually within the same year when you can sell them, convert them into cash. But like I said, bullion standard, the gold as bullion standard, gold cannot be considered as cash equivalent because it might be fluctuating in price. So you could get more than what you initially invested, but it could go down in the same case. So it's just like other things such as petroleum products. So it can be something which is current assets could be cash equivalents, which is market security, but therefore especially treasury as 90 days or treasury bills could be part of that. I mean something which is very much likely to give you the same amount that you invested in, and it could be used up within a short span of time. And then we have current liabilities as the existing obligations. So for instance, you have a mortgage which is payable in 10 years time. However, some part of that mortgage is to be paid in this year. So that would be the current portion of long-term debt. So when you talk about current liabilities, it strictly would not mean that you have to classify it differently. It would mean that it is payable in short term. So within the same counting period. So it has to be compared with current assets. Do your assets have the enough base or enough beef to settle the liabilities? So working capital, first thing, is the difference between current assets and liabilities, and that would just show you the excess of assets to liabilities. So you can have 80,000 in excess, then you can have ratios. Just simply current, have current assets by current liabilities. And a quick ratio is just a modified version of the current ratio in this case. Now, as you can see, it's current assets by current liabilities, but in quick ratio, it could be something more accurate. It could be cash equivalents plus marketable securities, and then divided by current liabilities. Then you can also have the debt ratio. And now they're talking about current ratio 1.8. Would that mean that it is a good value? They say that companies should have a credit ratio of 2 to 1 or higher to qualify as a good credit risk. When I talk about credit risk, it means that the banks would actually analyze the financial position, and make use of those ratios to determine whether they should be dispensing loan to that company or not. So Let's just move ahead with this. We have, again, as you see that we have receivables. Current, okay, now when we talk about receivables, could be account receivables because they have to be paid within the same period, account period, they have to be paid in 30 days. And if you do aging for accounts receivables, you will see that sometimes it exceeds the normal values. The normal days that are allowed for the return or for them to be converted to cash. And if, let's say, they exceed the 60 days, then they could be, grouped as bad debts. I'm not going to be teaching you bad debts at the moment, but what it means is that if they are not something to be recovered, or they're not recovered in the short term, then they would be written off. And always keep a provision for that. So this is also a common misconception in students that current, and if the receivable is not payable in the near future by the debtors, then probably they can be put off. It's not possible to put them off. Then we have quick or asset test ratio. We just add them up, cash, marketable securities, receivables by liabilities, just the same figure. Then we have debt ratio, which is liabilities by assets. So total liabilities by total assets, and then you can just determine that this is the ratio of liabilities to assets. So that is 33.333%. Let's say this could be. It's also hefty, but has to be less than 50%, basically. This is a long-term risk because you're talking about the whole picture now. It's total as compared to current. So gives you the long-term risk. So always know that companies usually, when we talk about performance, companies try to evade risk. And for that, there would be, the flow of capital would be in such ventures, in such investments which would give them with the least risk, they would get the highest returns. And the company which is able to do that is supposed to be performing the highest or performing in the best way as per the expectations of the shareholders in this case. So, and they're performing at par or even more than that. So, primary focus of the firms is risk aversion. But usually, the practice is that you have to undertake some form of risk to be able to have some returns, because returns and risk are directly proportional. So higher the risk, the more the return; the lower the risk, the less the return. But then they would like to experiment and invest in such projects or such business ventures which would give them maximum capital with minimum risk if possible at all. Then we can just simply go to a few questions in this case. So similarly, one of the ratios also price earning ratio. Then there's the earnings per share. Usually, when you divide the net income by the number of shares, you get just earnings per share. And price to earning is also market price of the share to whatever is actually the earnings per share. So all these ratios are key indicators of how the firm is actually performing the intrinsic value. So now we're talking about okay, so you can just start. We have had enough discussions. You can just attempt the discussion questions. Let me just look at now a few questions for you. Change in terms of both dollar and percentage. So let's just look at this one first. So now you see that this is the net sales of 150,000 in the first year. So the first concept is dollar and percentage change. So what would this entail? So we have net sales of 150 and then 189. So 189,500 minus 150,000. That was in the previous year by 150,000. So now, as you can see, this is 189,500 minus 150,000. So it's actually 39,000. So then the dollar value would just be 39,500. But if you want to convert it to percentage over 150,000. So this will be cancelled and you get 26.3%. Okay. Then we have the next is trend percentage. Like I said, for trend, you should have some base here. And so they have depreciation expenses on its plant assets as follows for 16, 17, and 18 respectively. For 16 it is 267, and then 18 and 368 for 2018, and for 2017 it is 289. Compute the trend assuming this as the base year. So now when you talk about the trend percentage, just divide each and every value with the value of the base year. So in this case that would be 267,000. So first by 267,000. So that is just 100%, right? Second, this was 2016. Let's say this was 2017. So this case would be 289,000. So we have 289,000 by 267,000. Remember that the base year would not change in this case. And for the third part, we have 368,000 by 267,000. We can simply divide this up. So I can just have 289 by 267 could be 108% actually. 108%. And this could be 368 by 267. 137%. So now as you can see that there's a trend that first is 100%, then comes, it increases. The depreciation expense is increasing at 108% more, 8% more than the previous, base is actually 100%. So it's just rising steadily. So you had the trend percentages for these years is because perhaps the plant is deteriorating fast, you have more depreciation, or perhaps it's a straight line method. It also depends upon the balance sheet depreciation measuring method. Some methods actually show the depreciation as having smaller value in the initial years and then more as years go by. And then there are some which would have them as equal value as straight line methods suggest, but you have also diminishing balance method. So then there's makers also and many others. So it also depends upon the company's policy that which estimation or depreciation estimation method it's using, and it could just diminish that or it could increase in the following years. It depends upon if it has changed its depreciation measuring method as well. Okay, so we have now income statement figures, and in this case component percentages. So now when we talk about component, it's very simple. What you see here is that for each component, by component I mean it's sales, cost of sales. So in an income statement, component would be each item that we have. So we have sales, cost of sales, gross margin, operating expenses, and net income. So now in this case we have, let's say, for every component, so this could be 100%. And that would be 340,000 actually by 560,000 for cost of sales, and that would be 40 by 560. And you have or 60.7%. Then we have gross margin as 220,000 by 560,000. And then you have 39.28%. I'm taking to at least two decimal places. Then we have operating expenses, OE, which is 160,000 and by 560,000. So now you can see it says 160 by 560. So you have about 28.57%. So can you simply write it down here? So you have first is 340 to 60.7. So I could just be putting it with a bracket, and then you have this as gross margin, which is 39.28. In terms of percentage, okay? So percentage. And then you can have 28.57. 28, I hope you can see this though, really small. I hope it's illegible though. It's 28.57 and it's 39.28. And then you just have the difference calculated directly, which is 39 points, just 39.28. Just have 38.99. I can just simply, find it out also by directly computing this 60,000 by 560,000. So 60 by 560 is 10.7. So now it's approximately the same value. If you simply subtract 39.28 minus 28.57, it's 10.71. Okay. So like if you calculate through this means or through this answer should be the same. Now let's just go for the next question. It's very important that you do all the brief exercises in this case, so when your concepts are developed for individual, ratios or trend changes and components, so you can have an idea about how to calculate each individual thing. Then you can do a lump sum or whole question based on different calculations, which are surmised through each and individual question which is put here. So now let's just look at this brief exercise. Okay, so now we have working capital and current ratio. So now what it says we have Harrisonburg Company have current and total assets of 470 and $1 million respectively. Okay. So company's current and total liabilities were 267 and 600,000 respectively. Calculate the amount of working capital and the current ratio. So you don't have to necessarily make use of the entire information or all the information provided to you in the question. So now you should always just focused on the formula. Current ratio is actually current assets over current liabilities. And working capital is actually current assets minus current liabilities. Okay, so now for this, just look at this. In the first part, we have the working capital, and so the current assets are 470,000, and the current liabilities are 267,000. 267,000. So now you can just simply subtract them. So you have 470 minus 267, and 203,000 as the working capital. Or you do the ratio for the same. So you have 470,000 over 267,000. You can have 470 by 267. That comes to about 1.76%. So it says actually 176 is actually 176. Okay, so this 176 would mean that this is more, and 1.76 times actually more than this. Okay, so now as we can see, it says 1.76 times more. So this is 1.76 times more than the value of current liabilities. Okay, then we're talking about the next part, which is quick ratio. So we have cash, accounts receivable, and inventory. Let me just drop this off. So now this is quick ratio. In this case, we have, so for quick ratio, what do we need? We need cash and we need accounts receivable. So we have the current and the quick ratios do the following. So current, for current assets, obviously when you're talking about the current ratio, you would just entail adding all of those. The current ratio in this case, you would just add 50,000 plus 80,000 plus 125,000 over, you can have current liabilities, just add them up, 45,000, 110,000 and 56,000. Okay, just add them, just get one single figure. This is 50,000 plus 80,000 plus 125,000, and this is 255,000 over, you have 45,000 plus 110,000 plus 56,000, you get 191,000. So that is across your current ratio, 1.33 in this case. So this is actually times, or this 1.33 times more than, or it's just 133%, it's just 1.33 times more than the liabilities in this case. Okay. So then we have the quick ratio. So just you can just multiply it with 100 as a percentage. So you just get 133 percentage for multiplying it with 100 as a percentage. Okay. But you can just express it as 1.33 times more than the initial value. So for quick now you can just have these two. So the value should be 50,000 and 80,000 by the same values in the denominator. It's 130,000 and by 191. Okay. 130 by 191. You have about 0.68. So this expressed as terms of percentage would be 68%. Okay. In that case was 33%. So now we're done with this because we have to take the current portion of the long-term debt in this case. Like I told you, it's part of current liabilities. We won't take inventories when it comes to quick ratio because we just take cash and cash payments. Even though we can take, but usually just cash, marketable securities, and receivables. And we have the cash and accounts receivable, but inventories, then always sell them or not sell them. Then you have 14.6 as a debt ratio. Current and non-current liabilities. Okay, so once so this is current liabilities. The company's current assets were 76 out of the total asset figure of this. The debt ratio would be actually total liabilities. So in this case would be current and non-current. So debt ratio. So we have debt ratio for 14.6. It would actually be total liabilities over total assets, and then that would be 160 and 210 over 4%. So now you can have 50% of approx 50% is 45.9. 45 point approximately 46%. 0.95. 6% is approximately 46%. Then you have net income as a percentage of sales. I'm sure you can do this. Let's just go to 14.8. This is earnings per share. So when you're expressing net income as percentage of sales, just simply divide the net income, sales, cost of sales, and operating expenses. You subtract from sales, cost of sales, and operating expenses. You get net income, and then you divide it by 560,000. So in this case, let's just say if I look at 14.7, so I could just have say 560,000 minus 255 and minus 130. Okay, so what do I get? In this case, 560 minus 130 and minus 255. And you have 175. So you express it in terms of sales, you have 31.25. Okay, that's so you can just express in terms of others as well. So now you have earnings per share, sales of 890, cost of sales and operating expenses respectively. So now you just simply divide the sales of so now you have sales of 890,000. So I will just simply write 890,000 minus 450,000 minus 245. You can just have 890 minus 450 minus 225, we have 215,000. And this is net income. Express it in terms of okay, now for shares you have divided by 10,000 shares. As you can see, we have $21.5 perhaps earnings per share. So this is shares, okay. So over here on the contrary, express it in terms of ratio because dollar cannot be cancelled by the number. It's quantity. This is quantity, and then you have the numerator as the dollar value. So now we can study the return on equity and returns in the next lecture. But usually when you're having returns, you have net income, operating was 475. Just average total assets was 3.5. Just divided by the average total assets, and you get the return on assets in this case. And then you can have similarly return on equity. You have net income, which is divided by the stockholders' equity. You can also do the default analysis in the next question. Try to do this to all the brief exercises, so we can just revert to the next part in the next lecture. So I thank you very much. I thank you, class. Thanks a lot for holding up. And let's just move on to the next part of the chapter in the next lecture. See you then. Goodbye.